let's say you happen to invest, and let's say you were good enough to get 20% per annum, not every year because it's not a bank account, it's the stock market. Future returns are not guaranteed, and they're certainly not certain, and past returns are not a guarantee of the future, and all those caveats absolutely hold true. When we talk about compounding of performance, this is what we actually mean. It's all very well talking about it in generalities, but what does it actually look like? And this is a pretty good image of that. It's from a government website, investor.gov, so have a look at that. Have a look at my campaignfor1million.com as well. It's got a lot of free resources on there for you. And let's say you started out today, whether you're in your 20s or 40s, you said to yourself, you know what, I've only got $10,000. This is how the returns would look. So why don't people do this? Why don't they bother? Well, first of all, they don't believe they can get returns worth investing and saving for the future. They think I might as well live now because I'll make more money forever. They tend to be over-optimistic when it comes to how much money they'll have in the future, and pessimistic about their future returns. Okay, so that's one reason. The other reason is, if you look at this, for many years, certainly up till about the first four, the actual value of your investing pot is not much different to the contributions you've made, because that whole compounding effect only takes takes effect a lot later on. Okay, so a lot of people in the early years, they think, well, yeah, it's going to, at least for the first 4 years, I'm going to have nothing to show for it anyway. And it's very difficult to get somebody to defer their future benefits. But in life, we tend to, research shows, and we tend to know that those who are willing to defer gratification and save for the future tend to have more successful, fulfilling, happier lives. Okay, have a look at campaignfor1million.com.